Nvidia's CEO says the idea that AI money moves in a circle is ridiculous. The credit market disagrees. The cost of insuring Nvidia's debt against default hit the highest level ever recorded the same day he said it. If you own an index fund, you own a piece of this disagreement, so it pays to know which side is right. This is the debt machine the stock market cannot see, and the credit market just repriced it. That machine hides in plain sight, in the footnotes of public filings, and it wears 4 different costumes. Learn the 4, and you can read the prices that move before the news does. The cost of insuring Nvidia's debt is worth one more look because that record is younger than it sounds. Those insurance contracts only started trading in November of 2025, so the highest level ever recorded means the highest since then. It is still a record, and it was set on a day when Nvidia announced deals, not losses. So what were credit traders reacting to? Days earlier, Nikkei Asia had added up the AI debt of 5 American tech giants. Some of it sits on the balance sheet, which is the public list of what a company owns and owes. That part comes to $1.35 trillion. The part that never appears on the balance sheet is bigger, $1.65 trillion. So these 5 companies carry more AI debt off the balance sheet than on it. These are among the most profitable companies that have ever existed. They do not need to hide anything. So what is all that money doing out there? There is a boring answer to that, and you are not wrong to expect one. It is mostly true, so here it is at full strength. Building data centers at this scale costs more than Meta or Microsoft earns in a year. So they borrow, or they bring in partners who borrow. That is ordinary corporate finance. Leases are ordinary too. Rent a building you do not own, and the rent is an expense, not debt on your balance sheet. A supplier helping its own customers pay is older than the technology business. Suppose a customer cannot afford your product. You can lend them the money, take a stake in them, or promise their bank you will cover them. All 3 are legal, and all 3 get disclosed. Then there are the people whose whole job is judging debt. Moody's is a rating agency. Think of it as the referee. Its job is to score how likely a company is to pay its debts. Moody's still calls Microsoft, Amazon, Alphabet, and Meta some of the strongest balance sheets in the world. That is the strongest case on the other side, and it is a good one. So every piece is fine on its own, except that hidden corporate debt already has a famous precedent, and that one ended in criminal convictions. The name is Enron. Everyone reaches for that comparison right now, and it is the most misleading thing you can say about this. I will come back to why, because the real answer is stranger than the one you are expecting. Enron comes back later. First, the boring answer, because every piece of it really is normal. The borrowing, the leases, a supplier funding its customer, those pieces were never the question. The question is what they build when you connect them. Follow $1. Nvidia sells chips to a customer. Nvidia also invests in that same customer or promises the customer's lenders that Nvidia will cover the payments. That is part of how the customer can afford the chips. The customer buys the chips. That purchase becomes Nvidia's revenue. That rising revenue is why investors keep funding the customers who buy the next batch. That loop has a name. It is called vendor financing, and telecom equipment makers ran it hard between 1996 and 2001. We will get to how that ended. Now the other half of the circle. Building the data centers takes real debt, arranged so it lands on somebody else's balance sheet, not Meta's or Microsoft's. Sometimes it sits inside a separate company that an outside investor controls. Sometimes it is a lease on a building that is not finished, which the accounting rules do not count until it opens. Or it is hardware ordered and not yet delivered, all of it legal, all of it disclosed, in footnotes. That structure has a household version. Co-sign a mortgage for your brother, and nothing appears on your bank statement. The obligation lives in a document, and it stays a document right up until the month he cannot pay. Then it is your mortgage, nothing on your statement, until it is everything. Money leaves as an investment and comes back as revenue. Debt leaves the balance sheet and comes back as a footnote. That is the circle. The circle is an idea until you watch it get dressed. It wears 4 costumes, each a layer deeper than the last. One of the 4 has a public test date on the calendar, and I will name the date at the end. Costume 1, the guarantor, the cosigner. CoreWeave rents out Nvidia chips by the hour. In a filing from September of 2025, Nvidia promised to buy any of that computing power CoreWeave cannot sell to anyone else. $6.3 billion of it through 2032. So Nvidia is the supplier and also the buyer of last resort for its customers' unsold shelf space. That commitment is signed and filed. The much bigger one is only a news report. In July, Bloomberg reported that Nvidia is in talks to guarantee OpenAI's rent on a data center campus in Ohio. A company SoftBank owns is building it, up to $250 billion of rent. Nobody involved has confirmed anything signed, and a scoop is not a filing. Why does that guarantee exist? To let the project borrow at a cheaper interest rate than OpenAI could get on its own. That is what a co-signature buys. Not money, a better price on somebody else's money. Costume 2. The tenant. Meta wanted a data center in El Paso, Texas, and did not want to build it alone or borrow for it. Meta and BlackRock set up a joint venture, a separate company they own together, to build the $14 billion site. BlackRock owns 80% of it, Meta owns 20%, puts in land and construction work, and signs a long lease on the finished building. BlackRock then borrowed $12.5 billion for the build by selling bonds to investors. On Meta's balance sheet, none of that debt appears. It shows up as rent. It is like renting an apartment you designed and furnished, where you are the only tenant, through a company somebody else owns. That is how a company ends up with more debt off its balance sheet than on it. Meta's off-balance sheet AI debt is estimated at about $420 billion. That is close to 3 times the debt Meta reports. None of it is hidden in the criminal sense. It is written down, in the footnotes, just not in the debt figure anybody quotes. And the bond market had an opinion. Investors charged 7.53% a year to lend against that El Paso site. That is one of the highest rates on top-rated data center debt since this wave started. Fewer buyers lined up than these deals usually get. That is what the debt costs once it has to stand on its own. Costume 3. The collateral, the thing a lender can take if you stop paying. CoreWeave borrows against its chips. In March, it closed an $8.5 billion loan, secured on its own hardware and one customer contract. Its total debt runs around $25 billion. A loan backed by equipment rests on one assumption. How long does that equipment stay worth something? CoreWeave's answer is 6 years. It used to say 5, and moved to 6 in 2023. 2 facts push against that number. Nvidia ships a new chip design every 18 to 24 months. And the rental price of last generation's chips has fallen 50 to 70%. 6 years is not a lie, it is an assumption, and unlike almost everything else in this story, it is an assumption with a test date. Costume 4. The price nobody sets. This is the deepest one. In August, SoftBank borrowed $10 billion for 2 years from 5 banks. The collateral is its stake in OpenAI. Those shares are private, no stock exchange lists them, so they are worth whatever the last funding round said. The loan carries a condition. If those OpenAI shares fall far enough in value, SoftBank has to hand over more collateral or repay early. That is a margin call, wired to a price nobody trades. This loan failed the first time. SoftBank went looking for the same $10 billion in May, and lenders cooled. The target was cut to $6 billion, and even that stalled in June. The sticking point was the price of the collateral, because nobody outside OpenAI sets it. Then in August, the full $10 billion closed anyway. Same collateral, same question, opposite answer, 8 weeks apart. It is like borrowing against a house no independent buyer has ever walked through. The value is real to everybody involved, right up until somebody has to sell. 4 costumes, 1 wardrobe. So who gets paid to see through costumes, and what are they saying? Moody's, the referee, rates 6 companies here, and in July it warned about all 6 at once. These companies used to be judged as software businesses. Software needs almost no buildings or machines, so the test was whether the product could grow. Moody's says they are turning into infrastructure businesses instead. Infrastructure gets judged on one question: does the cash coming in cover the debt on huge physical things that wear out? Same companies, different test. The referee just refiled a sprinter into the weightlifting class. All of this landed inside 3 weeks in July, in order. On the 21st, Nikkei publishes the hidden debt count. On the 24th, Moody's publishes the warning. On the 27th, 3 things at once. The report on Nvidia's new round of deals, the record price on its default insurance, and that 7.53% bond for Meta's site. 10 days later, SoftBank's margin loan closes. Separate prices, set by different people, all moving the same way. Now the promise from earlier, how the telecom version ended. Lucent, a big telecom equipment maker, committed $8.1 billion to funding its own customers. When those customers failed, across the suppliers doing this, between a third and 80% of those loans were never repaid. American regulators later found Lucent had booked more than $1 billion of revenue it should not have counted. Now Enron, the comparison everyone reaches for, and the one that points the wrong way. Enron's crime was not parking debt in separate companies, it was hiding them and faking the outside investors that made them legal. That collapse produced a new accounting rule, still in force. It decides when debt parked in a separate company has to appear on the balance sheet of the company that controls it. Today's structures are built inside that rule. Nobody here is dodging the post-Enron rulebook, they are obeying it, in footnotes, at a size its authors were not picturing. That is the strange part, not scarier than Enron, weirder. So what do you do with weirder? You cannot audit Meta, and neither can I. You do not have to. Every fact in this video was public, and the same 3 shapes keep turning up. Shape 1, a guarantee, one company promising to cover another company's payments. It costs nothing and shows nothing until the day the other company cannot pay. Shape 2, a lease through a company somebody else owns. That company builds the site and carries the debt. The tenant reports rent. Shape 3, a loan against something with no market price, where the collateral's value is an estimate everyone agreed to believe. All 3 have a published price, and none of them show up in a stock quote. First, the cost of insuring a company's debt against default. Traders call that a credit default swap. It is the price of a promise to pay you back if the company cannot. Second, the yield on a new bond, which is the annual return lenders demand before handing over the money. Meta's El Paso bond paid 7.53%. Third, what the rating agencies publish. Oracle, one of Moody's 6, sits 2 steps above junk, which is the label for borrowers the agencies think might not pay. CoreWeave is already rated junk. 3 shapes, 3 prices. They turn up in a filing, in a bond sale, and in a rating agency's notes. And they move first. So who was right, Nvidia's CEO or the credit market? They are answering 2 different questions. He is describing a business that is growing, and he may be right. The credit market is pricing what happens if the growth stops. Which brings back the test date. CoreWeave reports earnings on the 11th of August. Its stock will move on revenue, its debt will move on whether 6 years is still a believable life for a chip. 1 filing, 2 markets asking different questions. Stocks price the story, credit prices what happens if the story is wrong. If you want the next one of these decoded while the market is still arguing about it, subscribe.